all of them quieten down.
Quieten down. Okay, well, first rate's coming up, 25,950, 35. So just sort of starting up with not very much gusto at all. Nifty Bank is flattish, 0.13 odd lower on the Nifty Bank. The Sensex is down 0.14. Small cap index is down about 0.16. So it goes. So kicking off this Tuesday's session right now. Look at the advanced decline. I mean, it's too early, of course, with markets so slow. I think it'll take a little longer for everything to start to trade. But it's almost 1:1, advances to declines, right out of the gates, almost completely balanced with how many stocks are higher and lower. Nifty heat map gives you a quick sense of how the 50 stocks are opening, how many up and how many down, and then we will take it from there. Shriram Finance, once again, is the top gainer after that ratings upgrade. So, I mean, obviously, there was nothing unexpected in that sense. It was cost of capital coming down sharply for Shriram Finance. Was one of the big expectations at the back of which the stock re-rated. But it's doing well once again. So 1.7 higher on Shriram Finance. On the other end is iShares, Apollo Hospitals and Coal India, which are lower. So you got, what, almost 38, 39, 37 odd names which are lower, and the remaining which are in the green. But 40 points lower is the start on the Nifty, 25,900. So
hard to find any movers, really. What to say on the screen? Okay, let's see where the pressure points are. So Eicher Motors, like Prashant pointed out, 1% lower there. L&T is very sluggish this morning, down about 0.7%. Bajaj Auto, keeping Eicher company in terms of the two-wheeler space. That stock's also slightly lower. Titan, well, no sparkle of the lab-grown foray, not yet at least, 0.5% lower on that stock. There's Coal India, which is down. Interglobe, like I mentioned, is down about 0.5%. Tata Steel is cooling off. Yesterday, Tata Steel managed to clock some gains towards the end, but they're coming off now. Eternal, the stock that Manglam was highlighting earlier with the CFO of Blinkit resigning, that stock's down about 1%. So that's what we have. Shriram Finance is the clear leader, 2% up. There's some buying on Tata Motors, a little bit of buying on BEL. Yesterday, by the way, none of the defense stocks reacted to the DAC 80,000 crore rupee acquisition proposal. Not sure if that's reversing, but BEL for sure is not showing any action. Bharat Dynamics, etc. Most of them on the flattish side. 30 lower on the Nifty.
30 lower on the Nifty. You know, what's interesting is that for every stock from a sector which is gaining, there is an equal amount of stocks from that particular sector which is declining. So we're talking about metals, seeing some bit of profit booking or being absolutely flat. You have Hindustan Copper, which continues to do well. So Hindustan Copper is higher. NMDC is higher by about 0.8%. But then you look at some of these rare earth names, or you go down the ladder, you see, something like a GMDC, which is down about 3%. MMTC down about 3.5%. We have, HEG, another metals play, which is lower by about 3%, 3.5% right off the gates. Then you have a bunch of these new age companies which are doing well. But for every of those, we have a Nykaa, which is slightly under pressure. Indian Hotels and Interglobe Aviation are lower. But then you have Yatra, which is higher. So it is totally, mixed. I wouldn't even call it divergent and uncertain, undecided as of now. And that's what's reflecting in the kind of moves that we've seen in at least the first 3 minutes. So let's see how that goes.
Absolutely. So no real trigger push in that sense, one way or the other. So 25,900 kind of treading water. 58,800 something on the Nifty Bank as well. Nimesh Chandra is with us, Chief Investment Officer, Bajaj Finserv AMC. Nimesh, good morning. Season's greetings. Wishing you, your team, your family a very happy new year. What will bring the happiness in 2026 from a stock return point of view, Nimesh, though? It's kind of I was just wondering, right? I mean, I was off for a week and it's almost people have stopped talking about or even asking the question about this India-US thing. It's kind of gone into the background. Just because nobody's asking the question doesn't mean it's not important in that sense, right? What's your sense? What will be the trigger? Is it the plain earnings recovery? I mean, not to be scoffed at, but you think we need something more for this market to do well?
Good morning, Prashant, and season's greetings to you, your colleagues, and your viewers. Yes, it looks like a bit of a quiet end to a very exciting year, and I think people can enjoy that too. The sentiment actually is a bit low because of all the events that have happened this year. Otherwise, if you see, when I look at the economic cycle, we are in an upturn. The business cycle or the profit cycle of corporate, we are starting to see upgrades now and a much better outlook for next calendar year. And if you look at the credit cycle, that has also picked up. So asset quality is benign and you are seeing pickup in credit growth. Margins, at least for NBFCs, are doing better. Banks will slowly recover after they price in all these rate cuts. So I'm actually seeing the fundamental cycle, that is the economic cycle, the profit cycle, and the credit cycle doing well. It's the sentiment which is down. And I think what US-India trade deal can do is just offer that, a positive sentiment. Numbers-wise, I don't think after doing this deal, we will see any upgrades or major changes coming in the market-wide. Maybe some specific companies will definitely be benefiting from that. But overall, I think India is on a very positive footing. It's the sentiment which is a bit low right now.
Yeah, but one sentiment also is important, right? Feel good in that sense. But also, obviously, there are tangible reasons. There's no earnings upgrade. But if you're what has been 25 about? 25 has been basically about each country kind of sort of, looking out for themselves, building up their own. It's not just America first. It's like every country first for themselves. So you want to be kind of sort of, aligned with what has been a natural ally, right? Because it's not just about getting business, but so many other areas, right? So it's sentiment, of course, yes, it's a big one whenever this happens. But even otherwise, I think it's important, isn't it, Nimesh?
You are absolutely right. 2025 has been a year where, earlier we used to say that it's the markets that make headlines rather than headlines making the markets. But 2025 has been quite the opposite. It's the headlines that have driven the market. And the way these announcements have come, they have hit the sentiment quite bad. And because not only from the trade perspective, as you mentioned, people are looking at it from a geopolitical standpoint also, that are the relations between US and India strained. But I think if you look at the commentary from both sides, it's just that we've not agreed on certain terms of the trade rather than disagreeing with broader geopolitical issues or economic issues. I think there were a few points which maybe agriculture or so, which was a bone of contention for signing the agreement. Typically, these agreements will take time. I think the bigger agreement that we will sign will be with EU, because it will not only cover goods trade, it will cover services, it will cover investment, immigration, all those will be covered. And EU is the largest trading bloc in the world. So I think these things will get resolved. See, typically, when economic cycle or the fundamental cycle is doing well and the sentiment cycle is down, those are actually opportunities where you can actually go and invest in the market, because these are the situations that typically precede a good rally in the market. So I'm quite positive as we move into 2020 for the equity market.
I have a personal vested interest in the India-EU FTA. Like Chandan is saying, I'm also eagerly awaiting it, waiting for all the French wines and the Italian wines to hit our shores at much more attractive pricing, right? So yeah, that's going to be a big one indeed for things beyond wines, for sure. And maybe that'll make up for the fact that we are yet to negotiate this trade deal with the US. Take your point, Nimesh, entirely. I want to now talk about your portfolios and what you're doing and how you're sort of navigating this slightly confusing market landscape. And I was going through your December fact sheet. So it clearly says that overall, at a portfolio level, you guys are liking domestic cyclicals. And you're also seeing opportunities in consumption because the policy environment has been so supportive, right? Rate cuts, income tax cuts, GST cuts. So let's drill down on this one by one. When you say consumption, that's a very big basket. So what part of it are you most bullish on? There are jewelry companies that have done very well in the past. There is the entire platform play, quick commerce, so on and so forth. But that has its own issues with respect to cash burn and profitability. And then, we had a guest earlier on in the show who actually gave a positive call on just pure vanilla FMCG, just because it's so under-owned. So I don't know if there's any sense in looking at that. So divide your consumption thesis into all these pockets. There's travel, there's hospitality. So what part of consumption do you like and why?
So let me just quickly lay the context first on consumption. We are seeing throughout this year the income effect come because of income tax rate cuts that were announced in the budget. Then we saw savings impact coming because of the GST cuts that were announced. We've seen the wealth effect come because of the gold and the silver prices moving the way they have moved. Also, there is a bit of leverage impact also because interest rates have come down, and we've seen banks and NBFCs willing to grow their credit. So this is the context where consumption can do well. So we are positive everything from daily groceries, FMCG, quick commerce to about real estate. So we are across the board. Now, here then we have to see what is priced in, what sees better upside than the other, and what are the risks to this. Now, typically what happens when you're very bullish on consumption, you don't directly load up on FMCG because FMCG, you know, has its slow growth. It is a bit of defensive also because during economic downturns or slowdowns, it doesn't get affected so much. So you don't really load up directly on FMCG. You pick certain companies within FMCG staples which have higher growth or seeing some turnaround in businesses. So maybe some companies which are into aggressive growth areas, you can give them more benefit. And also quick commerce in a way is daily groceries and delivery. The second part is consumer discretionary. This typically does very well during consumption upturns. Typically the first to move are automobiles. And we've seen that happen this year. The auto stocks sharply rallied from there. Then we see pickup in the other, during festive times and during wedding season, you see pickup in other discretionary products, and which will probably now we'll see in electronics, in consumer goods, white goods. We will see that coming in this quarter and next. Also, maybe we'll see a good pickup in paint, the volumes, as well as because of the slowing competition, some of the companies may actually deliver better margins also.
You think on Nimesh, on paints, you think the worst of the whole competition, the price wars, all of that, is the worst of it done? And then would you go back to the existing, old established giants, or that's an interesting call. So just asking you for more details there.
So we actually became bullish on real estate. We became bullish on the rural as well as urban consumption theme, and paint somehow fits very well in there. And we saw initial pickup in volumes also in the last quarter. The competition slowing down its aggression is definitely seen, and last quarter numbers are showing that. So there is no aggressive player who is let's do anything for market share. We are seeing the regular competition, which is a little more measured and little more sensible competition. So we are seeing an upturn in the paint industry where the volumes have now started to pick up and pricing is not that aggressive. Add to that a benefit of the raw material cost, where now we will see improvement in margins coming also. So few important parameters of this business are actually falling in place for us to become positive. And yes, we are there with the leaders in this pack rather than the challengers.
All right, with the leaders, and the leader has shown a remarkable recovery from the lows, notwithstanding the underperformance that we've seen over the last couple of years from a shareholder return. And speaking about shareholder returns, an interesting stock this morning is Honasa. That's the one that should come up for you, down almost 3%. There was an interesting block deal that took place yesterday on that stock, where Fireside Ventures, the early investors in the company, sold out, and the buyer was Varun Alag, who's obviously the promoter of the company, the founder of the company, along with Ghazal. So the street would have thought that, with the promoter buying and the fund exiting, there could be a bit of a pop. That's not the case to be. The stock's down about 2%. The other part of it is also, it's way lower than its issue price of 324. So any sort of up move on this stock is met with a firm amount of supply. Nimesh, on these new age offerings from the IPO market, valuations are extremely high, but so is the long growth runway and the opportunity, the underlying opportunity. Where on the spectrum are you when it comes to this pack?
We are very positive on this pack. So digital consumer plays, we are very positive on. Yes, I mean, what we have in the portfolio is something, or those companies that meet our criteria where growth and valuation both fall into place. So we want certain companies which have good scalability for growth, customer ownership, certain moat or certain competitive advantage in the business.
Where in this place are you finding growth and valuation both satisfactory?
Yes. So in some of them, actually, the correction has been quite sharp. I mean, quick commerce has seen a very sharp correction already in terms of prices. Some we have been able to pick up. Initially, there was a euphoria in their listings and all, and then they have now corrected. Some of them have corrected to that level where they become interesting bets. And typically, today the investors are less patient because after COVID, they've made money every month. So they become impatient. If a company underperforms for one quarter or has some challenges for the short term, people tend to trash those companies and throw them at a valuation which is very low. And people actually are too disappointed with one quarter numbers that they change few years numbers. So those become opportunity for patient investors like us to pick up some of these companies. In many of these companies, you have to also dwell down in terms of the exact their P&L, in terms of what are the gross margins or what are they spending on customer acquisition, and how long will those ad spends or customer acquisition costs remain, whether they are trending down or trending up. So you have to do business by business analysis of those. But clearly, these are businesses which have huge runway for growth, and many of them are run with good management and have good moats. So we look at those, and you won't get them extremely cheap, but we want to pay a reasonable price for them so that we get a good compounding.
One of Nimesh, I'm sorry, I'm just taking a chance here. A couple of weeks back on Editors Roundtable, I think you were on and we discussed in these beaten down names, etc. Construction is a space, right?
Yes.
And I think one of the names which Nimesh put out, he put out some presentation of damage across stocks was KNR Construction. Was as one of the names that I'm not sure if that's the name that you like or have looked at, but I mean, just to use an example, those are those are spaces where you focus on, not spaces, but the kind of situations you would focus on.
So construction is a space we are now constructive on. So I don't know how that sounds, but we are positive on
constructive on construction.
And I won't comment on a particular name. Won't comment on a particular name, but people generally with the name Nimesh are very smart.
People with the name Nimesh, nice one, huh? You're on a roll, Nimesh. So, okay. Would you like to talk about, I mean, if you've looked at this, I mean, with full disclosure, not as a recommendation to buy or sell or anything, but have you done the work on this one or others?
Yeah, so what we do is we have certain screeners which actually give us contrarian picks in the market, where, say, companies which have underperformed for 3 years, 5 years, fundamentals have not deteriorated as much as the valuations have deteriorated. People have got disappointed because of certain short-term issues that the business cycle is going through. And typically, if you see, these were construction companies which were stars during the 2003 to 2008, 2007 rally in the market. Typically, these old old stars who are underperformers for the recent cycle, there is an opportunity or there is a chance that they may come back. So we want to look at them dispassionately and see whether there is an opportunity within these fallen angels or within these companies which have fallen sharply. Now, if you see in the construction space, and a couple of names that you mentioned, these guys have reduced the debt on the books or have sold off some of the projects that were hurting their P&L, cleaned up their balance sheet. And the order flow has started coming in well. As some of these areas like infrastructure development, real estate constructions, as these pick up, some of these construction companies would also do well. So these companies come as deep value picks. We have chosen very few where we are confident that the business model is good, the management is good, and they have taken an attempt to clean the balance sheet and improve their order books. So those we are picking up. A lot of real estate names are also coming now as underperformers for some time. Their stocks are down like 30-40% from their 50%. Right? And with low interest rates, mortgage rates being so low, it is likely that we see a pickup in real estate. So these are companies which are ancillary to infrastructure, real estate, and we like them.
Okay, so construction, real estate, and the further sort of derivatives of real estate, like you mentioned, cement, paints, quite interesting. So we have a fair enough idea about the way you're thinking about 26 and the way the portfolio is positioned. Nimesh, thank you so much. Great conversation as always. Wish you, your teams all at home a very, very happy new year. And we look forward to connecting again soon. Thank you for joining.
Do the same. Thank you.
All right, with that, it's time to move on and get to some corporate conversations. Before we do that, just a quick check on the screen. Nifty is down about 36 points. Mid-cap index is looking at a 0.25% cut at this juncture. So it's, again, very, very range-bound, listless. That's the kind of morning that we have. So let's turn our focus to Cholamandalam Investments. That's the next company on our radar. Of course, we want to talk to Cholamandalam about the growth prospects from here. And the company has already clarified. I mean, the last couple of days were all about this Cobra Post report that came out flagging or alleging certain corporate governance issues. The company completely clarified, saying that all of this is completely baseless, and it gave a point-by-point rebuttal to a lot of these allegations that were raised. So we want to move beyond that, talk about the business at large and what's really driving sentiment as we get into 2026. And for that, we have with us Mr. Arun Selvan, President and CFO of Cholamandalam Investment and Finance. Mr. Selvan, thanks so much for joining in. Season's greetings to you. Thank you for joining in. Hope you're set to wind down a good year, because at least for the financial landscape, for banks, NBFCs, it has been a good year, I suppose. I mean, growth has not been too bad. Stock price performance has not been bad at all. So, I actually want to start on a broader note, on the sector note, and then we'll talk about Chola and what you see ahead. This year will be remembered as a year for perhaps seeing the maximum foreign interest that we've seen in Indian lenders in a long, long time. Capital has been pouring in left, right, and center, from the Middle East, from Japan, from other parts of the West as well. So I want to start right there. As you've seen a lot of these deals happen, a lot of them with your peer companies, what is the thought? I don't know if anyone's been approaching Chola. I don't know if you're thinking of shoring up your capital buffers at all at this point. But are you thinking, more equity capital at all as we enter 2026? Are you going to be open to more deals if there are willing partners outside?
Yeah, morning. Certainly, we are open to any new interest in the company, but we always try to be self-sufficient. I mean, the philosophy within the company as well as within the group is that you have to fuel your own growth rather than keep looking at funding outside the system. This is what we try to do. We keep, I've already elaborated that if we grow at around 20 to 25% and we keep our pre-tax ROTA at around 3.5%, it is actually a good, refueling or the self-sufficient model, provided we don't go a little high on the dividend, which we never have gone to pay, exorbitant or high dividends.
Mr. Selvan, you're saying that you would be open to conversations.
We are open to conversations as long as it provides a meaningful, a positive impact to the company. But we are right now not looking at any conversations at all.
So there are no current ongoing conversations, but you would be open to shoring up equity capital.
Yes, it is always a good thing to do. But as you know, I am the CFO and there are more people above me, board is there and others who will also have a say on this. But I know the sentiments that if required, there is always a positive, and there has been no resistance on bringing equity if the terms are good, and we have brought equity many times in the past. Over the last 15 years, I've been myself participating on many equity issuances, and we are open to it. There is
okay, you are open to it so long as it meets your internal benchmarks of growth, internal benchmarks of the quality of capital and the nature of the money, and what the end use of that money would be, whether that enhances your cause, which is currently not particularly bad. I mean, with a 20-25% growth and the return ratios that you've set for yourself. You're self-sufficient, but a little bit of propellant would not be bad so long as it's the right fuel. Okay, you are the CFO, so let's talk about the businesses that you are looking at directly. You know, which segments do you believe that will need a bit of a push for disbursement? Because there's housing, home loans that have been a bit draggy, and then at the same time, the vehicle book post GST cuts. How has that business panned out? So if you could give us some color on each of the segments that you are, disbursing loans to, and how the health of that underlying industry is, specifically speaking from your standpoint.
Yeah, actually, vehicles have started moving up. We are seeing disbursement growth in double digit, and this quarter will be a good disbursement growth compared to the first 2 quarters. You will see the growth coming up in this quarter. LAP has always been growing, steadily at around 25 to 30%, and you will see the same 30% level of growth in LAP disbursements and LAP AUM. Home loan, which saw a little bit of a moderation in Q1 and Q2 because of various issues which we had discussed, will again show growth in this quarter, and you will see the growth coming in the home loan segment also. And the SME and the CSEL, as we have spoken earlier, we are doing some corrections in this. While in the SME, we have reduced the supply chain finance. So the disbursement numbers may still look a little lower, but AUM growth will be there. CSEL, which is our unsecured funding book, will also show growth, but it will be moderate as compared to the previous years. SBPL will show a good growth, about 30% plus. So we see overall a good traction, and we see 2026 also to be more positive. Right. Especially Q4 will be more positive.
Could you give us some numbers to quantify that? Because the second half of this year, the street really wants to know what's the kind of disbursement outlook that you have for the second half of this year. And if you could give us an AUM target by the end of this year and by the end of, FY27 as well.
Yeah, right now I'm not moderating any of the AUM target. See, okay. AUM is something which is like an elephant. It moves slowly. Disbursement will move. When disbursements slow down, AUM did not get impacted. Same way, when disbursements, grows faster, within 1 or 2 quarters, it will not show immediate impact. So we still would like to retain our outlook conservatively in the 20 to 23% growth levels on the AUM for the full year of 26. And 27 is a little far away. We need to see the impact of the H1 of 27 to understand how the seasonality plays out for the year 27. But right now, outlook is little positive, but it is little too premature to commit any growth numbers.
So will 20% plus disbursement happen in the second half? Because, for you to achieve 20% AUM growth, you will have to
certainly clock anywhere above 15% overall growth in disbursement. 15 to 20% certainly will happen in the second half. On disbursement, AUM will be in the 20 to 23% year on year at any point in time. And 27, we will see similar 20% plus growth on AUM. Right now, that is what I would like to keep it at. And then we will see as we go closer to the 27 financial year.
Right. Mrs. Hilman, good morning. Prashant here. Season's greetings, sir. Just a quick question. I mean, there was a big difference in cost of funds between you and Shriram Finance. With this big deal, their cost of funds are expected to come down sharply. Do you expect, in specific segments, increased competitive intensity?
See, we and Shriram play in different segments, actually. We are, in new and even in the used segment, what we play is the used vehicles which are less than 10 years on maturity after our loan expires. Well, Shriram plays more in the little longer used vehicle segment. We need to wait and watch how they would which markets they would like to enter, post this new money that has come in, and what is the direction MUFG sets them to move forward in. I don't think that would be a big impact for us in ways of our growth. And today we are not necessarily focused only on vehicle finance. We have grown books in other parts of the business, so we are not unduly concerned about it.
Unduly concerned, but vehicle finance is perhaps one area. But I mean, we got most NBFCs now not as, I mean, sector champions, but also doing many other things, right? Like you, and of course, I mean, Shriram now also is doing other things, and perhaps will do more things with this capital infusion. So just a quick point. Actually, two questions. MSME loans are doing very well. There was a CRIF Highmark report which said that the expectation is that because it's a segment which is doing quite well, public sector banks which over the last 3-4 quarters have lost share in this segment, and this is a segment growing north of 17, 18%, competitive intensity in this space is going to pick up quite a bit. For you, I think you classify this under this new business segment, right? CSEL and SME, MSME, etc. all together. It's about 12-15% of your assets. Do you expect increased competitive pressure here?
See, the CSCL is doing the unsecured segment of the MSME market, and the SME segment does the secured segment of it. These two, as of now, as you rightly said, is overall in the range of around 15% of our portfolio. We may see some impact on the banks coming in, but I think the customer profile, what the banks targets versus the customer profile we work on are completely different. So I don't see the overlap happening between banks and us. The banks are on a larger ticket size while we are on a slightly smaller ticket size. So we don't see this to be of a significant impact to us. Again, we'll wait and watch. Actually, see, SME segment is not such a high profitability segment. It runs on a very tight rota. But the cost of fund reduction would help compete in this segment. So we will certainly try and assess where we need to, make ingress into these markets.
So, Mr. Selvan, just one last question from my side. What's the big, I mean, if I can, how do I frame this? What's from a banking and a finance perspective, I mean, from your business perspective, right? Everybody's focused on disbursement growth and, well, the usual things. What, to your mind, what's the one big enduring theme, if there is one, for 2026 going to be, sir? What should investors really sort of, stay focused on?
See, always investors' focus is and will continue to be on profitable growth. Growth by alone will not make meaningful impact. Maybe in the short term it is okay, but in the long run it needs to be a profitable growth. That's what we focus on always. Like we want to do and grow segments which are profitable and will also has the potential to keep growing at a pace which is consistent, and so there is no yo-yoing in our performance, whether it is with regard to growth, with regard to NCL, with regard to profitability. So keep the expectations of the investors at a moderate pace and keep delivering them consistently. If we maintain this formula, I think investors would like us and trust us.
No, absolutely. And on growth, you've already reiterated your earlier promise that it will be more than 20%. Very quickly to round up the conversation, sir, when we earlier spoke, you told us that in the second half, your margins should start improving. I think the guidance has been about 10 to 15 basis points. And you had also told us that credit costs should actually come down. Now, off and on, we keep getting conflicting reports. When I spoke to some people who said that microfinance stress and unsecured stress is not entirely out of the system as yet. So just if you could revisit the asset quality and credit cost guidance, and also, margins, if indeed you see this margin expansion playing out in the second half.
Yeah, we will see. Thankfully, we don't have microfinance as a segment in our portfolio. Neither our unsecured segment is a large portfolio. We have seen certain stress in the unsecured because of the fintech exposure, which I am sure it will run down completely, or I would say almost 90% of it would get run down by the end of this financial year. So with Q4, the fintech portion of the unsecured exposure will run down. The rest of the portfolio on the unsecured is running fairly good, and we should see positive impact on that. NCL will come down and NIMs will improve. I'm confident about it. We will have to, so there should be a positive impact on the PBT rota.
Okay. All right, Mr. Selvan, we will leave it on that note. Thank you very much. You're sounding as confident as ever. Let's take this opportunity of wishing you, your teams, your family, everybody at home a very, very happy new year. May it be a happy, healthy and prosperous 2026.
Thank you, and wishing you the same. Thank you. Yeah.
Thank you so much. We'll take a quick break on that note, come back on the other side, lots more coming up, and we'll get a conversation going on the entire rare earth challenge. A lot of, the second half of this year was really spent on the crisis around lack of availability of rare earth, and then India swung into action looking at Atmanirbharta. Where are we on that journey? How long will it take? And what are the next milestones? We'll have a panel of experts joining in.
If there's one lesson global markets learnt in 2025, it is
Welcome back. The broader market seeing a fresh bout of profit booking. In fact, yesterday we had 2,000 stocks which were declining. And now as we speak, straight off the bat, we have 1,600 stocks which are lower as against just 980 stocks which are higher. So the crisscross lines, not crissing, not crossing. The red one firmly above the green one as we speak. The mid-cap index down by about 1/3%. But remember, all of this comes on fairly thin volume, so the impact cost is a lot higher. PB Fintech is lower by about 2%. We're also seeing some profit booking in names like PVR Inox, which had a good move in the earlier part of the month on the back of success of some of the movies that came by too. So PVR Inox comes up for you down in today's trading session. But let's talk about something that was extremely important and the most spoken about in 2025. It was the year where rare earths moved from the margins to the center of global power. Export curbs, supply shocks and manufacturing disruptions, they turned these minerals into strategic assets and actually forced countries, including India, to rethink how to secure their supply chains. We have Shivani Bajaj, who puts a spotlight on this year that made rare earth magnets really rare.
If there's one lesson global markets learnt in 2025, it is this: the country that controls supply chains holds the power. Driving home this lesson were rare earth minerals, a small group of elements that quietly rewrote the rules of geopolitics, manufacturing and energy security in 2025. The turning point came in April. China tightened exports licensing on rare earth elements. These elements are crucial for a host of manufacturing activities, from EVs to electronics to military equipments to renewable energy to a range of industrial processes. By October, those controls were expanded further to include magnets and even processing technology. But the impact was visible in April itself. Exports slowed, uncertainty crept into supply chains, and global manufacturing, from cars to clean energy, was suddenly left exposed. This wasn't about running out of minerals, it was about who controlled access to them. Now that's because while rare earths may be a group of 17 critical elements and global production stood at around 196,000 tons in 2025, valued at around $12 to $15 billion, the industries these elements supported were collectively valued at a whopping $7 trillion globally. In number terms, one electric vehicle needs about 1 to 2 kgs of rare earth magnets. One offshore wind turbine can use anywhere between 600 to 2,000 kilograms, and a single fighter jet uses more than 400 kilograms across systems and sensors. So in effect, without rare earths, motors don't run and modern technology stalls. In addition, there are very few alternatives to rare earths at scale. So China's move was a masterstroke of sorts, and it caught the world flat-footed because China mines around 70% of rare earths globally and controls 85 to 90% of refining and processing and produces over 90% of the world's permanent magnets. This means that even if rare earths are mined outside China, they often still depend on Chinese processing to be useful. All this makes the supply chains extremely fragile and ripe to be weaponized. Factory floors went into chaos. Global EV sales, for instance, took a hit. Magnet shortage led to cost pressures and production risks. In India, Maruti Suzuki cut its EV production target sharply to around 8,000 units from earlier 26,000 units. This disruption was real. For their use in defense manufacturing, rare earths were firmly classified as strategic minerals, and NATO countries started increasing their stockpiles. Adding to the chaos was the market-driven surge in prices of many of these elements. One striking example is the price of yttrium jumped more than 4,000% during the period of supply stress. And so started a global scramble for rare earths, with almost every country and government entering the race. The US and its allies committed billions of dollars to build non-China refining capacity. The European Union, under its Critical Raw Materials Act, set a target to process 40% of its needs domestically. And Japan pushed long-term supply contracts and recycling. As a result, over 300 million tons of rare earth resources have now been identified outside China. Over 146 projects are already under development to extract and make these elements ready for use. But there's also a reality that none of this will happen overnight, or even in a handful of years. India also found itself at a sticky wicket with Chinese weaponizing rare earths. We import nearly 100% of the rare earth magnets, despite being home to about 6% of the global reserves. India's manufacturing push, on which the government has based the big portion of its plans for Viksit Bharat, was suddenly vulnerable. The government responded with a 7,280 crore rupee scheme aimed at building domestic magnet capacity of around 6,000 tons per year. This was aimed at not only reducing its dependence on China for these elements, but also eventually providing the world with an alternative supplier. As 2026 begins, the global race for rare earths is going to get crazier and well more intense. Global demand for rare earth is expected to grow by around 700% by 2040, driven by energy transition, the global semiconductor push, and the drive for defense and space supremacy. With stakes so high, rare earth minerals are no longer just commodities. They're strategic assets, they're global bargaining chips, they're carrots and they're sticks. And in this evolving new world order, those that dominate supply chains can dictate terms, and everyone wants in on that security that it offers. Back to you.
Well, there's a wholesome, rounded perspective on this entire rare earths issue, or maybe a little peek into what lies ahead as well. But let's get some experts in. We have Sarada Bhushan Mohanty of Indian Rare Earths with us. We also have Nagarajan Mahadevan of Entelis Industries. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Mohanty, if I can start with you, sir, and same question I'll ask Mr. Mahadevan as well. You know, we've stopped talking about rare earths as we came towards the last few months of 25. Has the supply started, or has Indian industry and especially the Indian auto industry made other arrangements? Because, I mean, I don't recall any big breakthrough with regards to, supplies resuming from China or anything of that sort. So what's happening? What's the current state of affairs, Mr. Mohanty?
Yeah, currently, thank you very much for the opportunity, even. Actually, currently what has happened is this export restriction from the Chinese side with the end user restrictions. So with the commitment that it will not be used for certain kind of purpose, this has already been, some of the companies have already started importing. Some quotas are getting released. Although these quotas are there, but it is the process is a little bit slow. And some of the companies are already getting it. And particularly EV sector, they are getting the material.
Ms. Madhavan, same question. When I asked alternate arrangements, I meant, through, maybe not from China, but basically, what's going on, according to you, current state of affair?
Well, speaking a little bit into the details of the supply chain, I should say India has complete capability in terms of upstream, which is ores down to the oxide, which is the big material, which goes into making metal alloy and then into blocks. And finally, you have the value add or the downstream, which is components that goes into electric vehicles, etc., etc. To answer your question, supply has started with reference to my co-panelist, Mr. Mohanty's their oxide supply to us and to people in the industry in India, namely Ashwini as well as Midwest, I presume. Now, conversion of this oxide into metal and alloy on a commercial scale, we have achieved. And we would go into large-scale production probably at the date of time in the next calendar year. Speaking of downstream, yes, a lot of imports, only imports are happening. And, the trip point being the Chinese ban sometime in April this year, which brought awareness of the auto industry's complete dependence and also various electric vehicle associated industries complete dependence on this rare earth permanent magnet. Right. So the focus was being worked on for 2 years, the incentive program. So it brought a bit of the whole thing.
Right.
And what panned out is the 7,230 crore incentive. In simple terms, supply started at downstream. Midstream capabilities are there. Upstream has to be worked on completely.
Right.
Independent. Yeah.
That's exactly what I'm a little curious about. Mr. Mohanty, I wanted to know when you're in the heat of the crisis, there is commentary coming from across the board, and they are in a rush to go ahead and secure our future supply chain. But now that things have eased out a little bit in terms of import availability, etc., do you believe that the momentum which started in the heat of the crisis still continues, or that has fizzled out a little bit?
So actually, the momentum what was there earlier, so that has definitely has got affected. But the point is, it has developed one of the necessities, the mother of invention, this kind of situation. Once this kind of restriction was been made, so all over the world except China started looking at the production of this magnet outside China. So on that basis, the government of India come up with this, the MHI released its the scheme, so 7,280 crore. So that will be really a game changer. On top of that, people have started looking at this alternate arrangement of this rare earth magnets. So on that basis, all over all the countries, starting from Japan to Germany, US, all those countries, they are trying their best. And similarly, the ecosystem in India is going to be developed. And now the industries, particularly when those countries which are having the technology like Japan, Russia, Germany, and the US and South Korea, they are the talks are going on, and in that basis, what is looked after is in India's capability, the making
Yeah.
of the metals.
Yeah.
So from up to metals, they can
Mr.
collaborate.
Mohanty, Mr. Mohanty, I mean, sorry, I'm coming in over there because I'm glad you brought up that scheme, and we now have full details of this government scheme. The details were released only 2-3 days back. So I just want to take that up point by point. Indeed, the total outlay is about 7,200 and I think 50 odd crores, like Mr. Mohanty mentioned. And the details are as follows. There's going to be a sales-linked incentive worth 6,450 crores for production of 5 years. And the total capacity that has to be set up for rare earth magnets is 6,000 metric tons per annum. And this is to be distributed across 5 beneficiaries through a global competitive bidding process. There's also a 750 crore rupee capital subsidy for setting up these manufacturing facilities. Now, on paper, all of this sounds great, sir, but you tell us operationally, because I remember our last conversations, you said the issues are of technology, and you said that having certain technology tie-ups might be very, very critical. The issues were of certain type of inputs which are required. We might have the reserves, but we need the refining capacities. We require the other additional inputs to convert these reserves into usable rare earth magnets. So I'm not sure if the scheme addresses some of these operational challenges. Your thoughts?
See, basically the scheme is talking about it is inviting 5 different investors will be coming up to maximum to 1,200 ton of magnets can be provided. And minimum is 600 ton and maximum is 1,200 ton. By that way, 6,000 ton, which is the requirement, current requirement is around 4,000 ton. And by 2030, somewhere the 6,000 metric ton, whatever magnet will be produced, it will be consumed in the market itself. So particularly the preparedness of the market regarding the inputs. The inputs, particularly this dysprosium terbium, which is the heavy rare earth elements, these are not available in India.
Yep.
And this has to be imported currently. And India is also looking for like this hard rock resources. Hard rock resources is having this dysprosium and terbium. But that process will take little time. So in the gestation period, it has to be imported. So that is the one aspect. The other aspect is regarding this this scheme, particularly if you see actually this NdPr oxide we are supplying at the Chinese price, whereas this magnet price at China in India, if it will make it as per our calculation, current market cost it will be around $102 per kg. Whereas in China, it is $78 per kg. So there is a clear disability available in this around $24. So that alone, and as well as this depreciation, as well as the interest finance cost, because in Chinese capital cost and as well as their capex requirement will be lesser than.
So, sir, I'm sorry, we're running out of time. My simple question to you and the same question to Mr. Mahadevan is, the scheme says that over the next 5 years, we should be able to produce 6,000 tons of these magnets domestically. But given the concerns around inputs, technology transfer, etc., that Mr. Mohanty is highlighting, does this look like an achievable? The intent is great, but does it look like an achievable target? Just very quickly, Mr. Mohanty, and then I'll come to Mr. Mahadevan.
Yeah, can I come in?
Yes, please.
Actually, technology particularly, there are so many countries are there, like Japan is one, then the South Korea is there. But the technology is heavily guarded. They are just the wait and watch thing is going on. The discussions are on. Like Intel's Mr. Madhavan will throw light on this because they are making this powder magnet. So in the powder form, they are making it. So if they will tie up with these technological providers or like Ashwini Magnets or this Midwest, they will make up to the level of metals. So if they will tie up with these companies of India for making of the metals,
Sure.
and from metals to making of the alloys and
So let's ask him. Let's ask Mr. Mahadevan. Mr. Mahadevan, sir, ambitious program. Is the money that's been put up, the capital outlay, is that enough? And then the program says that over the next 5 years, we should be able to produce 6,000 tons of these rare earth magnets, starting from the oxide level all the way, up to the final product. Does it look feasible?
It does. It's not 5 years, if I can correct you. It is 2 years of gestation plus 5 years, which goes into production. So the span is 7 years.
Okay.
Right. And 2 years is adequate time for people to convert the oxide, which is the upstream delivery level, down to the midstream product, which is exclusively technology, know-how, HR intensive. We are very confident that this would happen in the country, and there's a lot of forums and a lot of academic as well as research institutes which are working on it, and also the government in different forms like Technology Development Fund and Technology Development Board, as well as NCMM, which is National Critical Mineral Mission. We're also putting this to happen. So in the 2 years' time, I'm very, very confident that the gestation would be over. In fact, Etalis is confident that we will be in about a year's time, getting into the sintered REPM's time to take advantage in the second year. The policy is not completely out yet. There are a lot of things, details, final details that one has to look into to answer it in terms of what kind of tie-ups. Tie-ups are extremely important with Indian or overseas entities is very important as part of the game. And this incentive is given at the push, and we've been in the industry now for 3 years, and prior to that, I've worked particularly on this particular industry for more than 4 years, along with my colleagues. People who are not willing to listen to India, subsequent to the incentive being declared, are very open and very willing.
All right, gentlemen, we'll have to leave it at that. Unfortunately, the audio is a little scratchier than what we'd imagined for it to be, Mr. Mahadevan. But Mr. Monty, Mr. Mahadevan, I'm sure this is a conversation that, calls for a bigger discussion, and it will continue. It's not something that stops with the calendar changes. So we will promise to have this discussion once again and take on
a better line.
And, at a time when we'll have a little more data to ask you on the real situation on the ground at that point as well. Mr. Monty and Mr. Mahadevan, wish you both a very happy 2026. Take a short break, come back, focus on the markets. There was an intermittent recovery. The Nifty moved into the green, but thereafter it's holding on to that by giving up a little bit. The Nifty is down about 11 points, a significant recovery from the lows, but still off the highs. Stay with us. Right, the Nifty is back in the green. It's a 142-point recovery from the low on the mid-cap index. The Nifty Bank briefly in the green as well. And the Nifty's up move actually, apart from the Nifty Bank, has been led by a lot of these auto names. So pull up something like a Hero MotoCorp, that's moved to the high point of trade. We're seeing some traction in M&M, Bajaj Auto, all of them as well as we move towards the end of the month, and more importantly, the start of the new year, where we will see some sort of sales come by. The street is looking at 2026 because December seasonally is the weakest month for auto sales. Banks, we have Axis Bank, which has seen an up move, and that's leading the recovery on the Nifty Bank. And we've also seen some purchase on Hindalco, which has again moved to the higher end of today's trading range so far. Hindustan Copper is the other one, which continues to surge up around 6%, notwithstanding the decline that we saw in commodity prices overnight. Good time to welcome Chandan Taparia of Motilal Oswal Financial Services, who joins us now. Chandan, we're finding support at lower levels. We're finding supply at higher levels. The only difference is that the range continues to get narrower. Where are we going from here on the frontline indices, and what individual stocks do you like?
Yeah, good morning, Mangalam. Thanks for having me. So Nifty has got stuck in between 25,700 to 26,300 from last almost 10 to 15 weeks. But the good part is that declines are being bought even after the absence of follow buying interest. If I look at the lower time frame, Nifty has negated or set to negate its lower top, lower bottom of last 4 days. It is taking support near its 50-day exponential moving average. So believe that some support-based buying could be there. So as of now, 25,800 is major support, which can provide us buy on decline stance for a recovery towards 26,100 to 26,150. So one can go with buy on decline with positive to range bound bias, but overall trend remain intact with a broader range. And as per the seasonality, we believe some more consolidation could be there in the market going forward. Talking about Bank Nifty index, it has been moving in between 58,700 to 59,500 from last 22 trading session. And now we are exactly at the lower band of the trading range. So we might see a negation of lower top, lower bottom after the profit booking decline of last 3 days. So with support of 58,700, we can see a bounce towards 59,500 kind of level. So in both the indices, buy on decline could be seen as we are trading at the lower band of the trading range.
You know, I was talking about Hindustan Copper in the morning, and I think it should come up on your screen. Last I checked was up about 5-6%. Any thought? I mean, this is of course after the 50% move. It's already seen in December. Any thoughts on this one? Hindustan Copper?
Yeah, Prashant, we are quite positive on most of the metal name. In fact, as per the seasonality, usually December month remains quite good for the most of these counter. And Hindustan Zinc, Hindustan Copper, Vedanta, National Aluminum are preferred counter. And Copper we have recommended many times. Even still at current zone, when stock rallied by more than 25-30%, we have the same conviction. And I believe that till it holds above 495, the ongoing momentum can extend towards 555 to 575. So I think bullish stance could continue and one can hold the position with trailing support.
What are your own trades?
Yeah, so talking about preferred trading ideas, first trade is buy on Mahindra and Mahindra. It seems that now Nifty auto index is at words of consolidation breakout. Mahindra and Mahindra has negated its lower top, lower bottom of last 20 trading session. We are witnessing some put writing and rollover seems to be better. Higher base is clearly built here, which is an early sign of the momentum to kick on. So one can buy with support of 35.70 for an upside target towards 37.50. Second trading area, there is buy on AU Bank. Major trend of the counter is positive. It has been making higher top, higher bottom on the weekly chart. And now it seems for a fresh breakout after the consolidation of last 12 days. Rollovers are betting better and we are expecting some short covering trigger in the counter led by coal unwinding. So one can buy with support of 970 for an upside target towards 1030. Last trading idea, there is buy on National Aluminum, positive on most of the metal counter. This is one of the strongest counter. Roll cost is positive with built up of long. Put writing is visible. In fact, we have seen surge in put call ratio. So recommending to buy on Nelco with support of 296. It can head towards 320, 323.
Thanks very much for that. Always good speaking with you. And Chandan, thank you for taking us through those specific trades as well. Season's greetings to you and your team and family. Well, what we're going to do is take a quick commercial break here. Manisha is going to join us with, of course, an eye on cryptocurrencies and how they've done in 2025, maybe some forecasts for 26 as well. Stay tuned, coming up. Well, welcome back. Let's shift focus to commodities, and you can't really call it a commodity, but maybe you can. It's been called the new gold, but I guess old gold is the new gold. Has been all through 2025. I'm talking about cryptos, right? Manisha is now standing by with what happened with crypto. Of course, when Bitcoin and other cryptocurrencies. Performance in 2025. Manisha really lagged behind. The real gold and precious metals, didn't it?
It did, yes. And, Prashant, you have to look at crypto in sense of two halves of this year. There was the first half for crypto, which was very bullish. You had various friendly regulations coming in. Prices were hitting all-time highs. But the second half really turned all of that around. But that happens with crypto. Every 4 years, you do see some profit-taking coming in. And this is pretty cyclical, the way you look at that. So I am also going to talk about crypto in two ways, the positives and then not so positives. When you come about positives here, well, crypto did enter mainstream as we did see it. You saw crypto being added into strategic reserves by various countries. Russia, US are a few to count with. And then you saw corporate treasury allocations come in as well. But in the first half of this year, I was talking to various US companies and they said, you're seen as not progressive enough if you don't have crypto on your balance sheet. So that is what the narrative was going around as well. And then we did see cross-border settlements as well when it came to crypto in this year. So it did come mainstream in various ways there. When you also look at the real-world asset tokenization, that also started to happen. Institutions started to come into the crypto as well as in sense of investors. So it wasn't just the nerds or the enthusiasts or even retail for that matter, but corporates, institutions and governments started talking about crypto. The regulatory policies that we saw come in from various governments also were more on the positive side, whether it was about Korea or Singapore, Russia, Ukraine, various European companies, and then, of course, to top it all, it was US, which continued to talk very, very positive about the crypto markets therein. It also is about the real-world application. So cryptozation or tokenization, real-world asset allocations is what we saw happen in this year on a very, very strong note when it comes to crypto. Add to that the fact that the spot ETFs did very, very well. Well, Bitcoin ETF was first launched in Jan 2024. It has been the most successful last year, and the momentum continued to build in this year as well. With $160 billion of a holding therein and trade, it clearly has been one of the top ones there. The market cap hit a record $4.3 trillion in this year, but that was all about the first half of this year. We also did see US introducing the Genius Act, and the markets are still waiting for a Clarity Act that was supposed to be cleared in the month of December. Doesn't seem to be happening right now, so we will perhaps see it in the first quarter of 2026. Apart from that, as the Genius Act came in, it was the stable coins. While we did see all-time highs for Bitcoin, but stable coins clearly took the cake away with capitalization at around $310 billion. Stable coin is something that almost all countries were talking about. And then if you look at the overall capitalization that it ran up, the Bitcoin prices hit an all-time high in the month of October at 1,26,000. They're trading at around 87 to 90,000 at this point in time. And that's exactly where the not so positives come in, because we did see a very heavy profit taking come in for Bitcoin there. It has declined nearly 35% from its all-time high in this year. The US Federal Reserve adopted hawkish stance, and that changed on how various asset classes were trading. You saw decline in equities in various countries. There also was money flowing into tangible commodities like gold and silver, and some money that came out of crypto perhaps also went there. A lot of ways that met with crypto were in sense of AI, and we saw money going in there in sense of electrification and in sense of investments as well. And then apart from that, it also has been about markets looking at losing $1 trillion in sense of market cap there. So from 4.3 of a high, we're trading at $3 trillion of a market cap right now. And then it was about US tariffs on China, the rest of the world. That also led to liquidation across asset classes, and crypto perhaps was majorly hit. Now, when you look at the prices therein on how the performance has been for 2025, if I was talking in the month of June, this was all double-digit percentage on the higher side. But right now, we are trading in the negative for most of them. You have Bitcoin, which is down 6.5%. Ether is down 12%. Both of these cryptos have seen all-time highs in this year. Binance is the only one trading in the positive. But look at Cardano, down 58%. The others which hold high in sense of market capitalization, like a Solana, Ripple, are down 35-11%, and 60 to 70% of a decline is how we are closing 2025 in sense of Polkadot and Avalanche as well.
Okay, so the money moved back to the OG asset class, I guess. Yeah. Gold and silver, it was. Cryptos, maybe for another year. We'll see if 2026 will be that year or not. But Manisha, thank you so much for the roundup. With that, we wind down this edition of Bazaar. Thank you for watching. Stay tuned. Chartbusters coming up next.